Hermès, a name synonymous with luxury and a stock that consistently defies market volatility. In this video, we're diving into Hermès to see why it's one of the best long-term investments in luxury and why it's much more than just a brand. I'll cut through the noise to reveal my fair value price and show you why Hermès deserves a place in your portfolio. Plus, I'll give a final star rating of the stock as well. And to get there, we'll walk through 4 sections, starting with a quick company snapshot just to give some context. So yeah, let's jump in. Let's start off with a brief snapshot of Hermès as a company over the past year. We can see that revenue and EBITDA is up, and we can see an amazing EBITDA margin of 48%. Now the share price has risen by 7%, and of course the company is headquartered in Paris in France. So what makes Hermès Hermès? Well, Hermès isn't just selling products, they're curating experiences. From their iconic leather goods like the Birkin and kellybags to their exquisite silks, fragrances and even home furnishings, every piece tells a story of heritage and meticulous craftsmanship. This dedication to artistry commands premium prices and fosters unwavering customer loyalty, which we'll later on see in the financials. So the bull case for Hermès rests on several pillars. First of all, we have unrivaled brand power. Hermès cultivates an image of timeless luxury, attracting a loyal customer base that sees their products as investments. We also have pricing power. Their exclusivity allows them to command high prices and maintain impressive profit margins. We also have consistent growth. Despite economic fluctuations, Hermès has demonstrated steady revenue growth driven by strong demand across its product lines. However, nothing is perfect, right? We have a few bear case pillars as well. We have dependence on luxury spending, right? Economic downturns can significantly affect consumer spending and luxury items. Now, this has not been the case before, but this might change in the future. We also have exclusivity versus accessibility. While their exclusivity is a strength, it's also limiting their ability to scale rapidly and tap into broader markets. So now we have a snapshot of Hermès as a company and of the bull and the bear case as well. Let's move on to the financial analysis and look at some historical data to show you what makes this company so unique. And I'll do that by showing you a few key charts of the data that I have of Hermès, starting off with the core financial performance. And here we can see a few very impressive things. First of all, we can see that revenue has grown consistently each year over the past 5 years at 24% on average per year. At the same time, we can see EBITDA is growing consistently, right, at 30% per year. This means that we're getting an expanded EBITDA margin, that is the EBITDA we get relative to revenue each year, right? Today it's roughly at 48%. It was all the way down at 40%, showing us that the company is also becoming much more profitable at the same time. Another interesting chart has to do with the debt sustainability to see if debt is any risk for us as investors investing in Hermès today. And yeah, I mean, there is no risk at all in terms of debt. We can see, yes, the company has roughly 2 billion euros in debt, but relative to the excess cash, that's almost nothing, right? And we can see that, I mean, debt has grown at 4% on average per year. At the same time, excess cash has grown at 20%, right? So, I mean, the debt to EBITDA margin, which is how much EBITDA we need to pay down debt, is basically at 0 times. We're targeting below 3 times. So yeah, at 0 times, debt is basically no risk for us as investors right now. And looking at the enterprise value performance, now the enterprise value is the market cap plus any debt minus any excess cash. Think of it as a more refined market cap of a company. We can see it has grown really nicely in the past 5 years at 28% on average. That's massive returns for investors. And we can also see that the average enterprise value to EBITDA ratio was at 35% in 2020, and now it's gone down to 32 times. So in that sense, the company has also become slightly more interesting in terms of a valuation basis as well. As we later on will estimate the future free cash flows of the company to get our fair share price, let's look at some free cash flow data as well. And here we can see the exact same story as we saw with EBITDA, right? We can see consistent revenue performance each year growing at 24%, and the free cash flow has grown at a massive 34% each year, which is really impressive. We can see, however, that the average free cash flow margin has been quite flat in the past few years, right? Leveling out at roughly 37 to 33%, which was the case in 2024. And the same story in terms of free cash flow performance is also reflected when looking at it at a per share basis as well. We can see that the free cash flow per share has gone up quite substantially, right, in the past 5 years, on average by 34%. At the same time, the average free cash flow yield has been quite flat, right, topping out in 2022 at 2.8%, and today we're at 2.1%. The final chart I would like to show you has to do with the share performance of the company, and this is really impressive. We can see that investors that bought into Hermès in 2020 have gotten 27% on average yearly return from the stock, which is really impressive. It has risen from roughly 900 euros all the way up to over 2,000 euros per share. At the same time, the number of shares within the company, which we can see in blue, the data here is in millions, has remained quite flat, right? They're not buying back any stock, but at the same time, they're not diluting shareholders as well. Now, with that said, let's give the company 2 price targets as well, which we will later on use in the valuation part. Now, we will start off with the enterprise value price target all the way up to 2034, and I'll go through you some of the key assumptions I have behind it. Okay, so starting off with the revenue growth, I'm assuming average yearly revenue growth in the coming 10 years of 10% per year. That's much lower than the average of 24% per year in the past 5 years in order to stay conservative, right, with my assumptions. I'm also assuming a EBITDA margin of 50%. That's slightly higher than the past year of 48%, but I think that's achievable for the company as they raise prices in the future as well. I'm also assuming a long-term enterprise value to EBITDA margin of 30 times. That's slightly lower than the 32 times we saw in 2024, right? Assuming as the company will become larger, growth will slow down, and then the multiple will compress slightly as well. Now, with all of those assumptions, which are quite conservative in my opinion, we get a price target in 2034 of roughly 5,600 euros per share. Let's also give the company a second price target, and I'll show you later on why we need both of these price targets. So this price target focuses on the free cash flow all the way up to 2034. In this case, I'm assuming 11% average year-over-year free cash flow growth for the company. That's lower than the 34% in the past 5 years, again, in order to stay conservative. I'm also assuming a free cash flow yield of 2.5%. That's slightly higher than the 2.1% we saw in the past year. And I'm also assuming 0% share dilution in the coming 10 years, as that's in line with the previous 5 years of the company's data that we have. And with all of those assumptions, we get a 2034 free cash flow price target of roughly 5,500 euros per share. As we now have 2 weighted price targets for Hermès until 2034, we'll just weigh them equally, right? And then we get a weighted price target of roughly 5,563 euros per share. And this we will use later on in the valuation part. Right, so now we're going through the historical data that we have of Hermès, and we've given the company a weighted price target as well. Let's move on to the interesting part, which of course is the stock valuation, and see where the stock lies in terms of its intrinsic valuation. So if we discount all the future cash flows that we're estimating for Hermès in the coming 10 years, we get a fair share price of today at roughly 4,000 euros per share. And that's a discount of 39% versus its current share price. This also implies an annual expected return that we as investors might get at 14% per year. And this to me is quite interesting, right? We're only assuming that the company will grow at roughly 10% per year, at least in terms of revenues, but we're getting a return that's higher than that. And that's partly thanks to increased profitability of the company as well in the coming 10 years, as we're estimating. And considering that our estimates are quite conservative, I would say that 14% is quite strong, at least on a risk-adjusted basis, versus the expectations that we have of the company in the coming 10 years. And before moving on to my final recommendation and star rating of the stock as well, let's look at my detailed estimates for Hermès in the coming 10 years. The important takeaway here has to do with the growth rates. You can see that the green dotted line, which is the free cash flow growth rate, is slightly higher than the orange line, which is the revenue growth rate. So I'm assuming profitability to continue to expand slightly, right, above the revenue growth rate in the coming years, assuming that the company will continue to expand its profit margins. And here is a complete summary of the investment case, right? If you choose to invest in Hermès today, you have to buy the stock. That's of course red, that's negative. But then you of course get free cash flows distributed to you as an investor each year, right? If that's dividends or buybacks or share appreciation. And then in 2034 you have to sell the stock, right? And that's where the price target that we got before comes into play. And then we can also see the total gains here in blue relative to the size of the investment that we have to go in today. And with all of that said, my final recommendation for Hermes stock is a strong buy, as you could have guessed by now. And my final rating is a 5 out of 5 stars. And one of the reasons why I've given the company 5 out of 5 stars has to do with the amazing quality of the company. And that amazing quality that Hermes has in terms of profit margins and in customer loyalty is really reflected in the stock. Here I have a comparison between Hermes and LVMH, which also is a huge French luxury giant, which owns over 70 brands across the world. And here we can see the relative performance of the two stocks. I mean, Hermes has grown at 270%, right, the share price in the past 5 years, and LVMH only at 50%. And this shows us what could really happen if a company is focused, it keeps its high margins, right, and the stock market wants to give credit for that as well. And here's also my final rating yet again, the 5 out of 5 stars for Hermes. Now, if you would actually challenge me to nitpick and find the weakest point in this rating, I would say it has to do with macro risks. We have tariffs coming out of the US right now that could be a headwind for Hermes being a European company, right? But zooming out, looking at the long term, I don't think that's a massive risk. The company has a strong brand, as I mentioned, so it also has strong pricing power. And if you would like to wait off and see if the stock goes down in price, this table shows you what happens to the estimated annual return if the stock goes down, which is green, that's good for us, or if the stock goes up, that's red, of course. And we can see it, we're at 14% today, but if the stock would go down by, I don't know, 20%, then we're at 16% per year, which is slightly more attractive. And if it continues to go up, let's say to roughly 3,000 euros, then the estimated return drops to roughly 10%, and that's not really that attractive anymore. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down the link in the description below, you get the free one-pager, which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.